Okay, in this video we'll be reviewing chapter 7, 8 and 10 that will be covered in our midterm exam 2. Let's start. So in chapter 7 we will be actually discussing the trade discount, cash discount, the gross method and net method, and let's see how do we record them. So the trade discount is the percentage reduction from the list price, okay, and quantity discount is also one kind of discount. If you purchase a lot of quantities, lot of units from a supplier, so definitely the supplier will give you some discounts. That is called quantity discount, okay. And the cash discounts, it is the most common discounts that is offered by the supplier so that the supplier can receive the money quickly. And we can see that there is a term over here, and the term, see, that is 210 and 30. It means that if you pay within 2 days, sorry, within 10 days, if you pay within 10 days, okay, you will receive 2% discount, cash discount, okay. But the N30, it means that you have to pay the net amount. The net amount you have to pay within 30 days, okay. These are the terms, meaning of the terms, okay. So the gross method versus net method, here is an example. So you can see that the Hawthorne Manufacturing Company offers credit customers a 2% cash discount if the sales price is paid within 10 days. It means that this is 210, okay. This is 210. Any amounts not paid within 10 days are due in 30 days, okay. And these repayment terms are stated, so 210 and 30 on October 5. Think that. So you must have a number line, the timeline, okay. So you will always try to draw a timeline when you are solving such kind of problems. So we are starting on the 5th day of October, okay. So October 5, the company sold merchandise at a price of 20,000. The customer paid 13,720. 14,000 less 2% cash discount on October 14, meaning so they purchased on October 5 and paid on October 14. It means that they paid within 10 days, so they will definitely receive a 2% discount, okay. And this is the remaining 6,000 was paid on November 10, meaning they did not receive any discount for the 6,000 that they paid on November 4. So let's see. There are two different methods, gross method and the net method. See, the gross method, we have recorded the entire 20,000. So accounts receivable debit and sales revenue credit. Okay. And for net method, we have recorded the accounts receivable, the net. Net means that we have subtracted the 2% discount from the 20,000. Okay. So meaning the 98% of the 20,000. So that is 19,600. Okay. And when we receive the money on October 14, under the gross method, we have received the cash 13,720 and sales discount, this one, and accounts receivable, the entire amount, meaning the 14,000. And under the net method, so the cash debit, the net amount, and the accounts receivable credit, the net amount, okay. But for the payment on November 4, okay, see that. So under the gross method, we will be recording cash debit and accounts receivable credit. Under the net method, the cash, we have received the 6,000, but accounts receivable would be the net amount, meaning after subtracting a 2% discount, and the sales discount forfeited is 120. So the gross versus net method, this is the conclusion. So we can see that sales less sales discount, okay. Then we add back discounts forfeited, so net sales revenue. See, under both the method, we have the similar amount of net sales revenue, but they are different, meaning they are recorded differently. So, estimating the allowance for uncollectible amounts. So, now balance sheet approach. So, balance sheet approach means actually in this method we will be calculating a certain percentage of accounts receivable as our bad debt, and we will create an allowance, okay, for that, and then accounts receivable aging schedule. So we know that. Let's see an example of the aging schedule. So this is the aging schedule, you can see. So the here are the different customers, okay, and here the age of the different accounts receivable, these different amounts, okay. So this means that the accounts receivable is outstanding or due for 0 to 60 days. The age, the 14,000, 50,000, 10,000. So total 220,000. Okay, account receivable on this date. So they have different ages. So 61 to 90 days due. We have total 50,000, and 91 to 120 days, 25,000, and over 120 days, we have 10,000. Okay, so from our experience, we know that the accounts receivable that is due for 0 to 60 days, 5% is usually estimated uncollectible. So what we have done is we have calculated 5% of this one, this 10% of this 50,000, 5,000, okay, 20% of 25,000 is 5,000, and 40% of this 10,000 is 4,000. So total 25,000, the allowance for uncollectible accounts, okay. And now we will be recording that. So I think that we have, see how much we have created. This 25,000, okay. So see here, this is actually different method. So we have post adjusted balance 40,000 and bad debt expense 28,800, and this is not related with that one. So, and the income statement approach, it means that we will be calculating bad debt expense on the gross sales amount, okay. So here in this example, we will be calculating the bad debt 2% of the sales amount, and here the total sales is 1,200,000. Okay, so bad debt expense debit and allowance for uncollectible accounts credit. And so this is the combined approach. So allowance for uncollectible, we have 24,000, and but we need a balance of 25,000. So we will be creating new 1,000. That is why bad debt expense debit and allowance for uncollectible accounts credit. So this is chapter 7, discard. So let's start with chapter 8. Okay, so chapter 8, types of inventory. This is not our concern right now. So raw material, work in process, finished goods, we know about that, and this is how to report. So then there are two different types of inventory systems. The perpetual inventory system that will tell you the continuous balance, and the periodic inventory systems. Under the perpetual inventory system, see, when we purchase inventory, we usually record the inventory debit and accounts payable credit. When we sell, accounts receivable debit and sales revenue credit, and we will definitely record the cost of goods sold and inventory. Okay, have that in mind. And the periodic inventory systems, cost of goods sold is equal to beginning inventory plus purchase minus ending inventory. This is how we calculate the cost of goods sold under the periodic inventory system. Okay. This is really easy. So under the periodic inventory system, when we purchase, we usually debit purchase and credit accounts payable if we purchase on credit, and if we pay in cash, definitely we will credit cash, okay, instead of accounts payable. And accounts receivable and sales revenue, this is when we sell. So the cost of goods beginning, see, and how do we calculate? So beginning inventory plus purchase cost of goods available for sale and less ending inventory, so cost of goods sold. This is how we calculate. So okay, here is the thing. So we need to be very careful about the physical units included in the inventory when we will be counting the amount of inventory that we have in our stock. So we should be careful about goods that are in transit. So in this case, we should be careful about pre-on board, that is shipping point, and destination. Okay, so be careful. So goods on consignment and anticipated sales returns, if there is any items in the possession of the company, so these items will be included in the stock of the inventory, and it depends on these two terms. These two terms are really important. Let's see. So goods in transit means that the goods are on the way to their destination. The goods are between the seller and the buyer. So let me show you. If here is the seller and here is the buyer, okay, and here are the goods, okay. Now the question is, who is the owner of these goods? Meaning these goods will be included in which inventory, seller's inventory or buyer's inventory. So it actually depends on the terms of meaning pre-on board terms. So if it is pre-on board shipping point, okay, if it is shipping point, then as soon as the ship leaves the buyer's dock, the ownership goes to the seller. So the goods that are in transit and the term is shipping point, then the ownership goes to the seller. Okay, and if it is destination, okay, if it is free on board destination, it means the ownership of these goods will be transferred to the seller when the ship reaches to the seller's stock. Okay, so be careful about those things. So accounting for goods in transit depends on the ownership of the goods. Okay, so if goods are shipped free on board shipping point, title transfers at shipping point. Okay, we know that. And if goods are shipped free on board destination, title transfers at destination. So these are the things. So be careful about this. This is one of the concept sake. And goods on consignment, this is another thing that we need to be careful about. In our class we have discussed that suppose Mr. Alex is producing something and he is in Texas and he wants to sell those items in Albuquerque. Okay, suppose Brian has a shop in Albuquerque. Okay, so if Brian has a shop in Albuquerque, then Alex will send some items, some of the units to Brian's shop. See, the ownership of those items will not be transferred to Brian. Just the goods will be displayed for sale in Brian's shop. Okay, so Brian will receive some discount for selling. So the ownership of these goods actually goes to Alex, right? So in this case, Brian is the consignee and Alex is the consignor. So be careful. The ownership goes to the consignor. And sales returns, if there is an anticipated sales returns, then we need to add those sales returns with our inventory. Okay, so purchase one important thing. So freight in on purchase. So in case of freight in, so be careful about the shipping point and destination, because if goods are shipped under the terms free on board shipping point, okay, it means that the ownership is transferred to the buyer as soon as the ship leaves seller's dock. So in that case, so under free on board shipping point, the freight cost will be borne by the buyer, okay, but in case of destination, the cost will be borne by the seller. Okay, so purchase returns, purchase discounts. Okay, so purchase accounts payable. So just as we did in the previous examples. Okay, so net method and gross method. So let's go to the the difference between perpetual and periodic inventory system. See, when we purchase under perpetual, we record inventory debit and accounts payable credit, but in periodic we record purchase debit and accounts payable credit. So inventory cash, freight in cash, this is for the freight cost, okay, and accounts payable inventory when we pay, accounts payable when we return goods in this case, and when we return, this is accounts payable and purchase returns. So these are the differences between. And okay, specific identification methods. This is the the average, first in first out and last in first out, these three cost flow assumptions. Okay, the average cost under the periodic system. So be careful about the periodic systems. Most probably in the exam you will be tested on periodic system. So the weighted average cost is calculated only at the end of the period. So beginning plus purchase, so goods available for sale, total in units, and so weighted average unit cost will be total cost divided by total number of units. This is the average cost. Okay, and perpetual average. This is okay. Now come on the first in first out, the periodic system. So the periodic system, what we will do when we sell, we will sell the items that we purchase first. Okay, so be careful about that. First in, first out. Okay, so we will be calculating cost of goods sold in that way. And this is perpetual. I am not discussing about perpetual inventory system, so I think you know about that. Okay, let me see whether there is any other thing to discuss. These are different things. Okay, forget about that. This is chapter 10. So property, plan and equipment under so long lived assets. So you will go to the go through our problem first. So think that the initial cost will be equal to purchase price plus all expenditures that are required to bring the assets to its desired condition and location to use, and the cost of equipment will include the purchase price, sales tax, and capitalization of expenditure. It depends on the nature of the expenses. If the expenses are long term and they are fixed assets expensed over a period of time and they are less frequent, they will be added with the cost of assets. Okay, and the short term, they generate revenue and maintenance of revenue generating assets, and they are highly frequent. Think about fuel cost and the initial cost of the equipment. See, purchase price, freight and handling, insurance during shipping, special foundation, trial runs. So they are capitalized. Cost, initial cost. Okay, let's go to, okay. This is the most important thing that you need to be careful about that. So the asset retirement obligation, it means that an existing legal obligation associated with the disposition or the retirement of a tangible long-lived assets. So these are the laws. So prior to 2001, some companies recognized asset retirement obligations gradually over the life of the asset, and now GAAP requires asset retirement obligations to be recognized as a liability and measured at fair value if the value can be reasonably estimated. So provisions of standards to address the scope, recognition, measurement, and present value calculations. Okay, so now think about this example. We have also discussed in the class this example. So this is the company paid 1 million and 500 acres of land. The cost of exploring for the coal deposit total 800,000, and intangible development, that is mine shaft 500,000. Jackson purchased new excavation for 600,000. After the coal is removed from the site, the equipment will be sold. So Jackson is required by its contract to restore the land to a condition suitable for recreational use after it extracts the coal. The company has provided the following three cash flow possibilities for 3 years. See, we will need these 3 years. Okay, so A, B, C, these 3 options, and the company's credit risk, meaning credit adjusted risk free interest, is 8%. We need to do that, calculate that. So now what we will do, so the purchase price, exploration cost, development cost, so we will be calculating this restoration cost. This is actually asset retirement obligation. So 30% of 500,000, 50% of 600,000, 20% of 700,000. That are the things. So this is total sum of this, and we will calculate the present value factor for period equal to 3 and I equal to 8. That is equal to 0.79383. Okay, so this is the total asset retirement obligation. So this amount should be added with the cost of the coal deposit. So we'll add this one. So our total cost would be this amount. Okay, be careful about that. And then the journal would be coal mine. This is the amount coal mine. The cash, this is the amount of cash we paid, and asset retirement obligation we have calculated. And for the equipment that we have purchased, that is excavation equipment and cash. And we also need to calculate the accretion expense every year, and that will be the risk-free rate, meaning that is 8% of this amount. Okay, so come on, so 8% of this amount is this. So our total amount is increased. So in this way, so accretion expense every year and accretion retirement liability, asset retirement liability. So think about if the actual restoration costs are more than the 590. Okay, so we recognize the loss. Okay, think that in this example we have the restoration cost was actually 625,000. So what will happen now? So asset retirement liability is 590 that we have calculated here, and the cash we have paid this one. So the difference between these two is our loss. Okay, that is 35,000. Intangible goodwill, then lump sum purchase. Think about the lump sum purchase. If we purchase a bundle of assets, so we need to allocate that total amount based on their fair values. So this here is an example. See, how do we do that? So this is the fair value. So this is total. So this one divided by this. So 15%. The same way. This one divided by this. 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 So we have this. So now we will be allocating these 2 million based on this allocation base. So this is how we did that. Okay. And the lump sum purchase and the journal entry would be land, building, equipment, patent, inventory, cash. Okay. Non-cash acquisition, therefore. Okay, so we will be discussing asset donation. No. So decision makers perspective. Okay, this is another thing that we need to be careful about. The fixed asset turnover ratio, which is equal to net sales divided by average fixed assets. So the average fixed assets means year 1 asset plus year 2 asset divided by 2. Okay, so let's see an example. See that this is one company Gap, this is a company Ross Stores. So the property, plant and equipment is given for 2015 and 16, 15, 16, okay, and the net sales is given for 2016. Okay, so let's calculate the asset, fixed asset turnover ratio. So which is equal to net sales, see, net sales divided by average assets, sum of these divided by 2, so which is 5.62, and for Ross it is 5.17. So this means that Gap actually can make, Gap is able to sell, to make sale of $5.62 for $1 fixed assets. Okay. Okay, exchange. Okay, now think about, this is the exchange, old assets and trade-in. We know that this is this happens in real world. So if you have one old iPhone, you can exchange it with a newer one, and you will pay the difference between the older one price and the newer one's price. So here is an example. Okay. So the company traded its laser equipment for the newer air-cooled ion lasers. So the old equipment had a book value of this one, cost minus accumulated depreciation, and a fair value of 150. To equalize the fair values excess in addition to the old equipment, the company also paid this amount in cash. So what we have to calculate is, so first one we paid cash 430. Then equipment old, meaning it has a value of 500,000, and the accumulated depreciation old one, that is 400,000. Okay, and now the equipment new 580,000. Is there any difference? Yes, there is a difference, and the difference is our gain. See that? How do we calculate that? Okay, this is up to be. So good luck with the exam.